Realty Nation, it's your host, Abhi Golhar. Welcome to the Think Realty podcast. Now, if you want to learn what permanent wealth really means and how you can think about the future instead of only thinking about the next deal if you're a fix and flipper or a wholesaler, or even if you are a multifamily investor or a single family rental investor, there are some strategies that you can put in place today to secure, control, and have certainty over your financial future. Today we're talking about that. My very good friend, Gary Pinkerton, will be joining us in just a second to talk about that specific thing and what are you doing wrong in your business? Or maybe not what you're doing wrong, maybe what you're missing, so that you can secure your financial future. Before we get to Gary, I need a huge shout out to the podcast sponsor for today, briefcase.email. Join thousands of readers and sign up at briefcase.email to receive a free weekly newsletter for real estate entrepreneurs. Briefcase loves to have fun with their newsletter. So if you don't laugh, if you don't cry, they'll give you your money back. All the laughing though, no crying. Go to briefcase.email to sign up. Okay, so I want to learn more about this permanent wealth idea. Because as a real estate investor, as a venture capitalist, as somebody that has my hands in a bunch of different businesses, I'm thinking to myself, okay, isn't that my retirement? Isn't that the way that I need to be thinking? And as many of you real estate entrepreneurs are very similar, you're very much in the same boat, that's the retirement that we're building, right? Gary, welcome to the show, man. How are you doing?
Hey, thanks, Abhi. It's awesome. I always enjoy talking with you, my friend.
Hey, likewise. So there are a lot of entrepreneurs, real estate entrepreneurs, that think that way. They're like, well, my retirement is what I'm building for me right now. You know, I'm the one that's flipping properties. I'm the one that's investing in multifamily. I have a very active hand in building my retirement and in building my long-term savings strategy or financial freedom strategy, whatever that looks like. As we're starting the show, you talked about this idea of permanent wealth. I want to get to that.
Yeah.
What does that mean? And then we'll do the intro.
So to me, when I say permanent wealth, what I'm talking about, it could be generational wealth with other people, right? But primarily when I'm talking about permanent wealth, I'm trying to get across the concept of lasting wealth. And so I completely agree, by the way, with all the real estate investors out there and the active investors, people who are running a syndication business with larger apartment buildings, mobile home parks, whatever, as well as those that are just doing rehab and the burst strategy, right? So I agree with all of that. They are definitely adding value. They're adding sweat equity. They're running a business, and they're the ones, their own value that they've added to the world also adds value to their family. Specifically, income comes in because somebody saw value in what they did and they paid them for it, right? So totally agree. That is the most important asset in their lives. And Abhi, you and I have taken a look at the hierarchy of wealth, is what we call it at Paradigm Life. And for me, that was fundamental when I was trying to figure out what's going wrong or not correct, at least in my own life. 25 years in the Navy and the submarine force. And I was still completely laid out there, a victim, when 2008 came around, because all of my finances were at the very top of the pyramid, the highest risk point of the pyramid, because I didn't understand the relationship between control and risk. And so, you know, permanent wealth means lasting staying power. It means that you have the ability to sustain what you've got going on through good times and bad. A lot of people in 2008, real estate investors, went completely bankrupt. And they think in their mind they were over leveraged. They had a lot of leverage, but the leverage is not what broke them. What broke them was that they took the money when they leveraged a property and put it into another one. They had no liquidity. What they really experienced was a liquidity crisis, and they didn't have the ability. They hadn't set themselves up for permanent wealth.
The same thing can be said of Airbnb investors, right? Those that didn't control the property, or they didn't own the property and they were JVing with the homeowner to do an Airbnb kind of deal, and it was like this weird like backdoor way of doing it, which, fine, I'm all about being creative, but if all you're doing is putting yourself out there constantly from a financial perspective, and you're maxing out on your finances, and you're not using debt properly, then yes, you run into this major issue, and you can own 300 single-family rentals, and it feels great to say that you do that. But if you're cash flowing less than $50 a rental, what are you doing with your life? you're really missing the game. So I wanted to start out answering the question of permanent equity before I actually had you do your intro. So now give me a little background on who you are and what you do.
Yeah, so I alluded to it a few minutes ago. I grew up in Southern Illinois on a dairy farm in the late 70s, early 80s. And when I was a freshman in high school, we lost our farm because of the extremely high interest rates that existed during that period of time. It was after the big gas crunch that we had in America. Interest rates were screaming up. And we had 18% interest rates on our farm. And we lost the farm after a year or so of trying to survive in that environment of continually refinancing to lower rates that would immediately pop back up. So I have this innate respect for high interest rates. And it's what drove me to purchasing rental properties and getting fixed rate loans on them over time. But it also is what, living in a trailer borrowed from my uncle when I was in high school, as a family, led me to respect personal finance and understand what went wrong and how to make it go right. And, fast forward through a career in Navy nuclear submarines. I went to the Naval Academy to get out of Illinois at the time, long career in Navy nuclear submarines, and just a fundamental, awesome time, right? It was amazing. Worked with, had the opportunity to command a submarine called the USS Tucson and deployments in the Pacific Ocean. Just great crew, loved my time. As I was leaving command, I had gone through the kind of lay yourself open experience of all of my money being subjected to market loss. And I realized I really didn't have control of anything. And so I pulled all my money down into rental properties. Why did I choose rental properties? I could have chosen McDonald's franchise businesses that I was going to run personally. It didn't matter. I was pulling money back to a more high control area where I was involved in it. And just like you mentioned about people who are running the real estate business, I was more in a controlled position there, much further down the pyramid. And, a decade later, I have 30 units, 20 properties. I'm invested in some syndications and mobile home parks and things like that. I love tax efficient vehicles and talking to my clients about it. But about 3 or 4 years into owning my rental properties, I kind of stumbled into it by a desire after reading Robert Kiyosaki and Robert Allen and some others. I wanted to do no money down, right? I wanted to limit my own money in the properties. It led me to putting essentially my cash into life insurance policies, whole life insurance policies, treating them like a banking system. Your audience may have heard of it as infinite banking, and borrowing the insurance company's money and using their money to purchase the properties, the down payment side. I've gone on to do that by purchasing, borrowing to purchase businesses, really anything you want to purchase. But it causes you to have this really, really large foundation of cash in life. And 2020 taught me that it was this is probably not new. It was polarizing for everybody out there. But I would say if you really want to simplify things, you had people that were scared, that didn't have much cash sitting around. And you had people that were opportunistic. And the same thing happened in 2009, right? They saw opportunities because they weren't fearful, because they had a clear mind. And that clear mind was created from having a bunch of cash sitting around or having created a business where the cash flow does not stop, if that makes sense.
No, that makes sense. And we talk about this hierarchy, this wealth pyramid hierarchy. Can you maybe describe what that looks
Sure.
like? Because a lot of folks take a look at their high risk investments and they're building, or their high risk activity, let's say, and they're building a business in that high risk topmost category.
Yeah.
They might have a couple of ETFs, they might have an IRA, they might have like a solo 401k, things like this, which frankly probably don't have as much money in there as we should, right? Like if you're watching this, nod your head. You're like, yeah, no, that's me. I didn't really contribute to my Roth IRA or my traditional IRA just yet, or my 401k. I should be doing more of this. So if you don't mind, Gary, maybe identify what that hierarchy kind of pyramid looks like. And I do want to dive a little deeper into what it means to be invested in a whole life insurance policy. So that's coming up in a second.
Absolutely. Yeah. So think about Maslow's hierarchy of needs, or just a pyramid in Egypt, right? And you just break it into 4 horizontal layers. And on the bottom, the foundational layer, just tier 1, and then tiers 2, 3, and 4 as you go up. And if you could put a big arrow on each side, and an arrow pointing down that indicates you have more control the further down the pyramid you are, like control about dying or going bankrupt, right? So obviously, about if you're standing at the base of the pyramid and you fall off, well, it's not that painful, right? But if you're way at the top, that's higher risk. So you have more control at the bottom and you have higher risk at the top. And this is and then so we put the investments in tiers 2, 3, and 4, specifically directly controlled investments, things that you're directly involved with. Then indirectly involved, this is like a limited partner or a passive investor kind of thing, like I am in a mobile home park, for example. And then at the top is speculation. And there's kind of different levels of speculation. The very top of the pyramid, the apex of the pyramid up there would be, if you think about the Luxor pyramid in Vegas, this is a good analogy, and that beautiful beam of light coming out of the top of the Luxor pyramid. Well, think about being at the top of that pyramid, but you're inside there playing roulette with all of your wealth on some number. Pick number 13, why not, right? And spin the wheel, right? At that moment, you have no control over anything, and therefore you're totally at risk, right? And then think about the foundation of the pyramid is like your money is in a very strong safe hidden in your house or something, right? That's pretty safe. And so there's a spectrum between there. And so I believe in building the pyramid from the bottom up, having a strong foundation of savings and protection. And that's where, my main product, my main day job of introducing people to this idea of life insurance comes in, or whole life insurance as a bank, right? And then above that is the direct investing. That's your business. That's your real estate. And then above that's a little more passive and a much more passive at the top, right? And so we kind of break things down that way, how much control you have over the future. It's not really about what kind of asset it is. I mean, listen, Apple stock could be really risky, but for Steve Jobs, Apple stock was not risky, or even maybe a senior employee, because they understood, they were connected to it. They had the insight and the control about where their money, went. But somebody like me who was just randomly picking it, that'd be risky, because I don't know. They just had a board meeting and decided to bring back 8-track tape players and kill the iPhone, right? I didn't know that because I'm just a simple passive investor.
Right. So that's a really good. It's a really good visual too. The higher up you go on the pyramid, the less control that you have, the riskier it gets. If you're at the bottom of the pyramid and you're kind of working on those savings accounts and you're working on your 401ks, et cetera, you have a lot more control over those type of investments. Where does the whole life insurance policy fall?
Yeah. So one important thing to remember, and a lot of people get this wrong who are in my industry talking to individuals about it, and I think it really clouds the topic, right? They like to talk about life insurance as being an investment. Remember, the top 3 tiers are investments: investing in yourself, your business, et cetera, or investing in some stock right at the top. But the bottom level is not investing. It is foundational. It is savings and protecting, like protecting your family and your finances from bad things happening. For example, your house burns down, you didn't have insurance on it, right? That could be devastating to many people. Car burns down or whatever, right? Or get into an accident. Health insurance, you don't have health insurance and you have open heart surgery, right? Or life insurance, the most important money-making asset in your life typically is ourselves, right? And we don't insure that thing, our family specifically, from the loss of that thing if you get hit by a bus 30 years early. So that's the protection side. Then there's the saving side. Most people, listen, if we're playing the game correctly, if we've learned from liquidity crunches like 2008 and 2020, or we're sitting there thinking about our business and going, you know what? I'm going to spend $100,000 on this new equipment that I think is going to make me $1 million. But if I take the last 100,000 I have, I'm not confident that's going to work out, right? But what if you had another 100,000 sitting there? So if you have enough liquidity, it causes us to have the confidence and the certainty that things will still be okay, and we will take that leap. So having a lot of cash sitting around, people resist doing that because they don't want it sitting in a savings account earning nothing. But the moment you can put it in a place where it's going to earn 4%, maybe 5%, earning without taxes, right, and compounding, then all of a sudden we're like, okay, we'll have a little cash sitting around. I went into the 2020 crisis where the mayor in every town I owned real estate in stood in front of the camera and said, hey, tenants, we know you're having a tough time. You don't have to pay, you don't have to pay rents until the foreseeable future, right? And they're still saying that. Thankfully, a lot of mine did pay. But I took a quick look at how much money I had sitting around on life insurance policies, and I had 2 or 3 years worth of mortgage payments. I didn't really plan on that at the time. I had a couple of deals that got paused. But I'll tell you what, the next time and from now forward, I've learned that lesson. And being able to sleep really well at night when a lot of my clients struggled, I'm not going to relearn that one.
So as we start, very points really well taken, right? There are so many rental investors out there, whether on the multifamily side or a single family side, they're like, holy cow, I had to front this. I had to front these. Yeah. I still had to front the payments, but I wasn't getting as much income in. And the moment that tenants have an opportunity to not pay, the idea is okay, if you can pay, you should pay. But they're also thinking in the back of their heads, well, I could have a crisis of my own too, and if I'm just going to take advantage of the system and don't have to pay, then that becomes a problem
Yeah.
for you, right?
Yeah.
So point well taken. There are a lot of folks, like I've done a lot of research on whole life insurance policies and how to use that, I guess, as part of a wealth building strategy. You are the only person that can help me understand that the best. Everybody has their own spin on it, and
Yeah.
I just, it's a world that, I mean, you can go to YouTube or you can call Gary, right? Like that's kind of what it is. It's like go to WebMD where you can get freaked out if you go to the doctor's office and it's like not some malignant tumor and then you realize it's just a zit on your face, right? Like it's
Right.
go to the doc. So
Right.
where what a lot of people get wrong online is like this cash value and the fact that it can either get sucked out or your policy can go to zero. Help me understand that. And then that'll be my last question. And then I want to make sure that we get your contact information out there because this is like a really, really important topic. So
yeah, that's awesome. I appreciate that, Abby. And it reminded me that I've been really focusing on this being a foundational cash savings vehicle, but I don't want the listeners to walk away thinking, oh, I can't use the cash. It is completely liquid. It's about 80% liquid on day one, and it gets over 100% by, let's say, year 5, right? So it's really close to everything contributed is liquid, able to be used. And I borrowed against mine day 3 of having my policy in place to purchase my first rental property with it. So, and I've borrowed 20 sometimes since then and have 19 loans out right now. So it's very, very liquid, very able to be used. And that's why they call it a banking system, because you can borrow against that cash value while it sits there. You're basically using it as collateral for a line of credit, just like you would your home or something. And it's growing very strongly in a tax-free environment in the background. But pulling the cash out, having it go to zero, all that kind of stuff. There's 2 kinds of life insurance, of permanent life insurance, they call it. One of them I would call not permanent. It's sold by people who want you to think about this thing as an investment, and it's called universal life insurance. And it's term insurance with a savings account on it. But it's not guaranteed to be around forever for you. Your cash value is not guaranteed from being lost. And so as a result, I don't think of it as permanent, but the industry does call it permanent. And then there's whole life insurance. And whole life insurance from these mutual companies has a 200-year track record, never losing money for anyone, growing on a guaranteed increase every year, and adding dividends for every year they've been in existence as well. And dividends are just profits to the owners of the company who are policyholders for mutual companies. So it has, a few different methods in which your account value is guaranteed not to go down and guaranteed to go up. So I think that probably addresses the, cash value going to go to zero and money not accessible side. It totally depends on, you need to make sure you're in the right vehicle to start. And then you have some guarantees that are going to make this the best banking system you've had in your life.
Man, I'm with you. Like, I think there are a lot of these folks that are out there that are just thinking, I'm doing all these projects, I'm doing all these flips, I have all this stuff going on. And even if you max out your IRAs and your 401ks or /403bs if you're in the education space, what more can you do? And I don't think the answer is listening to Dave Ramsey or Susie Orman. There's a new world of money. There's a new rule of money or new rules of money that you have to follow. And a basic outline, Gary talked about. Right? He talked about this hierarchy that you need. You need foundational, permanent wealth building strategies. And hey, nobody's saying you should not take risk. Like if you're younger, take all the risk that you can in the world. But also keep in mind, if you set up your whole life insurance policies properly, then you're also locking in a pretty low rate that you're paying every month. Because only know this, and Gary, correct me if I'm wrong, as you age, your insurance policy quotes they get more expensive over time. Mm-hmm. So something else to keep in mind. Anyway, I would love to keep talking about this all day. What's the best way to get in touch with you so that we can continue the conversation? Because there are a lot of folks that are now thinking, well, geez, I need this in my life.
Yeah, well, my dear friend Aaron Chapman calls me a narcissist for using this. I was going for simplicity, but it's Gary at GaryPinkerton.com. So nice. Trying to make it simple was truly my goal. I look forward to helping anyone with the concept of, the pyramid, or my business partner and mentor in this world, Patrick Donahoe at Paradigm Life, wrote a great book that I'll send you a copy of that talks about in a couple of chapters that concept.
Gary, thanks a lot. Thanks a bunch, man, for the insights. It's always great catching up, and always blowing my mind with this kind of stuff. who would have thought universal life versus whole life, and there are major differences, and you need to select the right one. Just going to your bank and sitting down with your financial advisor there and getting sold on this universal life concept, it's not going to work out for you the way that you think.
Not when you get older.
Yeah, right. And you need a specialist like Gary to come into your life and restructure it so that you can go and do what you love to do. Gary, thanks a lot for the time. GaryPinkerton.com, everybody. We will catch up very soon, my friend.
Always a pleasure. Thanks, Hobby.
Thank you very much. Think Realty Nation. This next segment is brought to you by Think Multifamily. Whether you're a passive investor looking for passive income or an aspiring syndicator looking to learn how to grow big and fast, Think Multifamily is the industry's leading acquisition and education company. They're here to help you invest for your family's future every step of the way. Visit www.thinkmultifamily.com. Okay, so we're talking about on rentcafe.com, there was a blog written about the top trending locations in America for Generation Z. All right, for Generation Z. I'm just going to share these with you real quick, and I'm kind of thinking it's really interesting. Number one, Greenville, North Carolina. It looks like they're just smaller kind of cities. I'm not really seeing any major large cities here. Are you kidding me? It's nuts. Okay, number one, Greenville, North Carolina. Number two, Little Rock, Arkansas. North Little Rock, Arkansas is number three. Norfolk, Virginia is number four. Lake Charles, Louisiana. Warren, Michigan is number six. Number seven, Fort Wayne, Indiana. Number eight, Erie, Pennsylvania. Number nine, Toledo, Ohio. Number 10, Durham, North Carolina. It is really interesting that, and these are and the percent change, they're significant. They're upwards of 50% of where these Gen Zs want to be. It's so interesting. And I think this is where a lot of the conversation has been with even institutional funds to start capturing the secondary and tertiary markets. I mean, you take a look at Greenville, North Carolina. That's not even a secondary market. That's so far from being a secondary market. It's crazy. So I have no idea. This is nuts. Okay, quote, the cities of Little Rock and North Little Rock, Arkansas, with a combined population of around 250,000 people, take the second and third place as the trendiest locations for Gen Z. This area doesn't lack in opportunities nor in hospitality, making for an attractive and affordable place to live in with an average apartment rent around $800. So it's kind of interesting as we start thinking about the next potential renters that we need to target as real estate investors. Gen Z. Does it make sense to start tracking what they want? You bet it does. That's the show for today, folks. If you have any questions, feel free to get in touch. You know how to do it by visiting www.thinkrealty.com. We have a conference coming up toward the middle of September 18th and 19th, and it's a hybrid in-person and virtual conference. It's in Baltimore, and you want to set your sights on making 2021 a success with more knowledge and know-how by networking and learning with top-tier real estate investors and professionals. For a limited time right now, what you can do is go to thinkrealty.com/Baltimore and register for 2 tickets. And if you type in the code podcast, it will give you 1 ticket off. So it's a 2-for-1 deal. So how about that? We made that happen for you. I'm going to be there in Baltimore in September, so I highly encourage you to come out and check it out for yourself and shake some hands or bump some elbows or give some hugs or say some hellos. And I think that's it. You know how to get in touch with us. You can find me anywhere online. And until next time, happy investing.